Welcome to this explainer. Look, today we're going to completely flip how you think about the artificial intelligence industry. We're looking way past the endless software hype, the chatbot benchmarks, and the virtual magic. Instead, we're going to pop the hood and examine the massive physical and financial engine that's actually running all of this. Because as we're about to see, the AI boom isn't just about writing the best code anymore. It's about concrete, cooling, credit, and community consent. $130 billion. Yeah, billion with a B. That massive number, it represents the total value of AI data center projects that were stalled, blocked, or just flat out rejected in the first quarter of 2026 alone. Let that sink in for a second. For all the talk of this unstoppable AI revolution, an incredible amount of the physical infrastructure required to power it has suddenly hit a brick wall. So what's causing this massive brick wall? Well, it's public backlash. According to a recent Gallup poll, a staggering 71% of Americans now strongly oppose having AI data centers built in their areas. I mean, that is a higher level of local opposition than you'd see for a nuclear power plant. The industry is literally facing a crisis of consent. To figure out how we got here, here is our roadmap for today. First, the heavy reality of AI. Second, the bottleneck is consent. Third, the circular financing loop. Fourth, pathways to a shakeout. And finally, the big consolidation squeeze. All right, let's dive right into Section 1, the heavy reality of AI, or as I like to think of it, the infrastructure wall. You know, for the last 2 decades or so, we've lived in the consumer internet era, and that era felt, well, wakeless. Software could just scale infinitely on regular old commodity servers. But today, the AI era is incredibly heavy. The limiting factors aren't just clever algorithms anymore. Today's AI is this massive industrial reality that needs actual concrete, highly specialized cooling systems, and literally gigawatts of power. So where exactly is all this money going? It's basically pouring into 5 massive buckets. First, you have the compute hardware, mainly those crazy expensive GPUs everyone wants. Then, cloud services. Next, the actual physical data centers, meaning the concrete shells and those intense cooling systems. Fourth is power, which means buying new transformers and hooking up to the grid. And finally, networks, those high-speed interconnects that keep those pricey GPUs from just sitting there twiddling their thumbs waiting for data. It is a seriously heavy, capital-intensive stack. Moving right along to Section 2, the bottleneck is consent. Let's talk about the local pushback. For the last couple of years, AI developers priced in the chips, they priced in the power, and they priced in the capital. But they completely forgot one tiny thing: local consent. Forbes actually hit the nail on the head here, noting that permission to operate is the 4th unpriced input of AI. Basically, developers just assumed communities would roll over for the sake of tech progress. But wow, they were wrong. And these communities, they're pushing back over some very real, tangible issues. We're talking about staggering amounts of water being sucked up for cooling in places that are already dry. We're talking about the endless, noisy hum of diesel backup generators. Residents are terrified of massive strains on their local power grids, which could actually jack up utility rates for everyday families. Add in a total lack of community input, and you get a boiling point. I mean, this isn't just a few complaints online. This frustration recently sparked 142 protests across 42 states. Places like San Marcos, Texas have even slapped outright zoning bans on data centers. The reality is AI developers absolutely cannot ignore this anymore. If you treat local consent as just some late-stage permit checkbox, well, you've mispriced your entire project from day one. Look, you can always speed up a hardware order by throwing more money at it, but you absolutely cannot buy your way out of a zoning fight with an angry town. Local trust completely dictates the timeline now, which means it dictates the financial viability of these multi-billion-dollar builds. Which brings us to Section 3, the circular financing loop, and how the industry is masking these delays. To really understand the money side, we need to talk about a critical concept: circular financing. Basically, this happens when capital injected on one side of a deal returns, either directly or indirectly, as revenue on the other side. It creates this closed loop where the survival of the whole chain completely depends on that money constantly flowing back around. Let's actually walk through how this works step by step, because it's pretty wild. Step 1, a massive tech platform gives an AI lab a giant pile of cash. Step 2, that same AI lab turns around and uses that exact money to buy cloud services and compute from, you guessed it, the same tech platform. Step 3, the platform points to all that cloud spending, tells investors, look at all this massive demand, and their valuation shoots up. So the money has effectively just traveled in a big circle to artificially inflate the demand signals. Now, before we call this out as some sort of massive scam, we should realize rational actors are doing this for very logical reasons. They're using this loop to lock down incredibly scarce GPUs and power capacity in a super bottlenecked market. They also do it out of competitive urgency. Spending a ton of money is actually a defensive moat against rivals. And of course, they do it for the optics. They need that proof of demand narrative to go out and raise even more capital. It's basically a coordination solution when resources are scarce. But here's the catch. This loop has birthed a really fragile middleman layer that we call neoclouds. These are specialized infrastructure brokers who take on mountains of debt to buy GPUs and lease data centers. They justify all that debt based on the contracted payments from those AI labs. So this entire house of cards assumes that these circular commitments are always going to be paid out, and that the AI labs will just endlessly get fresh funding to foot the bill. All right, Section 4, Pathways to a Shakeout. Let's look at what happens when the funding actually slows down. According to the research, if this bubble pops, we're basically looking at two primary scenarios. First is the slow crash. Think of this as a gentle deflation of all the hype. Enterprises realize the ROI just isn't there, capital spending decelerates, and compute prices just slowly drop over time. The alternative? The fast crash. This is a sudden, brutal credit event. Lenders freak out and tighten their belts. Companies hit a wall where they literally can't refinance their debt, and you get forced deleveraging that causes outright panic selling across the whole industry. And the pressure points for a crash like this are incredibly specific. You've got leverage and maturity mismatches, basically borrowing short-term cash to fund long-term concrete infrastructure. You've got unmet utilization on strict take-or-pay contracts. And maybe the scariest part, the insanely fast technological obsolescence of GPUs. If the music stops, older GPUs become completely worthless, incredibly fast. Plus, the secondary market for this hardware is controlled by a tiny, concentrated pool of buyers. So, if GPU collateral suddenly loses its value, it could trigger a terrifying cascade for literally anyone holding that debt. Which brings us to our final section, Section 5, the big consolidation squeeze, and how competition might just get completely choked out. Look, there is a really hard truth for the tech world to swallow here. The superior technology absolutely does not always win. It isn't just about having the absolute best, smartest AI model. Out in the real world, it's all about default distribution. Whoever controls the everyday digital surfaces that you and I and massive enterprises already use, well, they control the ultimate adoption of AI. Take Google, for example. Just look at their massive choke points. They own search, they own the ad networks, Chrome, Android, and the entire enterprise workspace. They don't actually need to build a standalone AI that you have to go out of your way to find. They can just seamlessly bundle a good enough AI into the workflows you're already trapped inside of. This lets the tech giants entirely bypass the race for the absolute best model and just squeeze out independent challengers through sheer distribution gravity. And honestly, this creates a pretty brutal reality for those independent startups. A standalone AI company, they have to actually earn a profit margin directly from their AI product just to survive and pay off those massive infrastructure debts. But an incumbent AI, a giant tech monopoly, they can absolutely afford to run their AI at a massive loss. They just cross-subsidize it as a shiny retention feature to protect their existing digital empires. I mean, talk about an uneven playing field, right? Which leaves us with this final, absolutely vital question to ponder. As this massive physical build-out slams into furious local communities, and as these circular financial loops get tighter and more dependent on endless hype, we really have to ask, when the music finally stops, who is left holding the stranded capacity? Who actually pays for the empty data centers and all those rapidly depreciating GPUs? The answer to that question is going to define the next decade of technology. Thank you so much for joining me for this explainer. Stay curious, keep learning, and I'll see you next time.